Hi everyone, thank you for watching our advanced option trading course. This video is titled Chapter 10.8, Rules to Follow and Mistakes to Avoid. In this short video, we're just going to go over some common rules that we advise to follow on a daily basis if you're looking to trade options. But more importantly, we're going to highlight some very common mistakes we hear from our investors all the time. And we want to make sure that we highlight them so that young investors, novice investors, or even experienced investors don't fall down the rabbit hole and get hurt with some of these common mistakes. So let's get straight into it. So the first two rules that we recommend have to do with liquidity. The first one has to do with the underlying stocks liquidity, and the next one has to do with the options liquidity. Only choose stocks which have adequate liquidity. This means preferably they trade on average over 500,000 times per day. So the underlying stock trades at least 500,000 times per day. That would represent adequate liquidity. Anything above that, it's good to go. When you're choosing the options contract, also you want options contract which have adequate liquidity. Adequate liquidity means something that is at least 100, preferably over 500. And we're going to get into it a bit later, why liquidity is so important. Mainly, having a more liquid stock only has benefits to it. There's no downside to having more liquidity. If there's more liquidity, you get a smaller spread on the bid ask. It's easier to buy it. It's easier to get out. There's just so much more benefits for having a liquid stock. If you buy a call and the stock price goes up, and you bought a call which has a low open interest, you may have trouble selling that call even though you're profitable on it because there's no buyer out there that's willing to buy it off you. So you got to be really, really careful if you are buying or selling options which have a low open interest. Good rule of thumb, at least 100, preferably 500. Next, think twice about exercising a long-term option because you'll miss out on time value. Remember, the longer the options contract, the more time value that's in it. There's more chance that the stock price can go up or down. Next, if you need stock movement, if you're looking to implement volatile stock movement, either up or down, or you're bullish on your stock, you need to remember to give yourself enough time to be right. Remember that time decay accelerates exponentially in the last month before expiration. So if you need the stock to move either up or down, you need to give yourself a minimum of 3 months to be right. And we showed you throughout numerous strategies that if you need stock movement to either up or down, do it over a minimum of 3-month time period. Also, you know you will not be holding the contract in the last month. So you need to give yourself at least 2 months before you need to sell. Why are we not holding it in the last month? Well, the time value and time decay accelerates exponentially in the last month. So if you're holding it, that premium will significantly decrease in the last month, and your profit will significantly decrease, especially if the stock's staying flat. You don't want to hold options contract in the last month. As option strategies become more complex, just remember they are based on just 2 basic options, calls and puts, 100%. When we looked at expert level and advanced option strategies, there was a lot of complex strategies there. But if you break them down to simple terms, all you're doing is either buying a call, buying a put, selling a call, and selling a put. And if you break it down into those simple terms, which you want to master early on, then it all becomes really, really easy and simple in your mind. So there's some general rules. There's a lot more, but we just make sure we never deviate from this basic, simple rules here for option trading. So now let's move on to some mistakes to avoid. So we're all creatures of habit, but most habits are worth breaking. So option trades of any level tend to make the same mistakes over and over. I know I'm guilty of it, and I'm sure some of you are guilty of it. And the sad part is, most of these mistakes can be easily avoided. So here are some common mistakes you need to avoid. After all, trading options isn't easy. So the first mistake that people avoid is not having an exit strategy. And you've probably heard this one a million times before. When trading options, just when you're trading stocks, it is critical to control your emotions. That doesn't necessarily mean you need to have an ice flowing through your veins or that you need to swallow your fear in a superhuman way. It's much simpler than that. Always have a plan to work and always work on your plan. And no matter what your emotions are telling you, don't deviate from it. How you can trade smartly. So planning your exit isn't just about minimizing your loss on the downside if things go wrong. And people make that mistakes. They think about having an exit on the downside. It's also on the upside. You should have an exit plan, period, even when the trade is going your way. And this is probably the hardest one to break. You need to choose your upside exit point and downside exit point in advance. It's important to keep in mind with options, you need more than upside and downside price targets. You need to plan for time frame exit also. Options are a decaying asset. With stocks, you can hold them for as long as you want, but options are a decaying asset. And that rate of decay accelerates as your expiration day approaches. So if you're a long, a call or a put, and the move up you predicted doesn't happen within the time frame you expected, you need to get out and move on to the next trade. So you need to cut your losses and move on. Time decay doesn't always hurt you, of course. When you sell options without owning them, you're putting time decay to work for you. In other words, you're successful if time decay erodes the options price and you get to keep the premium from the sale. But keep in mind, this premium is your maximum profit if you're short a call or put. The flip side is that you're exposed to potentially substantial risk if the trade goes wrong. The bottom line here is that you must have a plan to get out of any trade, no matter what kind of strategy you're running, whether it's a winner or loser. I focus on winner here. Don't wait around on profitable trades because you're greedy, or stay way too long in losers because you're hoping the trade will move back up in your favor. What if you get out too early and leave something on the table? Well, people always say that. They always get afraid, like, I got out too early, I left some on the table. And this is the classic trader's worry. It's often used as a rationale for not sticking with the original plan. Here is the best counter argument we can think of. What if your profit was more consistent, reducing your incidence of losses and sleeping better at night? Trading with a plan helps you establish more successful patterns of trades and keeps your worry more in check. Trading can be exciting, and sure, we all love it, but it's not about one-hit wonders. You will not become a millionaire from one trade. It shouldn't be about getting ulcers from worried either. So make sure you plan in advance and stick to it like super glue. So if you want to make 30% on this trade, calculate what does the stock price need to move to make a 30%. Also, if you don't want to lose more than 20%, calculate what the strike price has to fall to, if you're on bullish on it, to only lose 20% and get out. Remember, if things go wrong, it's okay to get out. I can guarantee you will not be successful with every single trade. Not even the best traders in the world are not always successful, but it's also about minimizing your losses and maximizing your gains. And minimizing your losses is all about having a plan when you want to exit it. The next mistake we want to implement, the next mistake that a lot of investors make is do not double up. And what does that mean? So as a stock trader, you've probably heard a justification for doubling up to catch up. If you like the stock at 80 when you first bought it, you're going to love it at 50. So it can be tempting to buy more shares and lower the net cost basis on the trade. But be wary. What can sometimes make sense from a stocks often does not fly in the option world. Doubling up on option strategies almost never works. Options are derivatives, which means their prices don't move the same way or even have the same properties of the underlying stock. Although doubling up can lower your per contract cost basis for the entire position, it usually just compounds your risk. So when a trade goes south, you're contemplating the previous unthinkable. Just step back and ask yourself, if I didn't already have a position in place, in this trade, would I make it? And if the answer is no, then don't do it. Close your trade and cut your losses. Find a different opportunity that makes sense. Options offer great possibility for leveraging using relatively low capital, but they can blow up quickly if you keep digging yourself deeper. It's much wiser to move on and accept a loss instead of setting yourself up for bigger catastrophic losses later. We never double up. If we predict the stock to go up and it falls, we're not going to double up on it because our initial assumption of it is wrong. So when it goes back down, why do you think it's going to go up? You were wrong the first time, and the first trade is always your most educated, is always your most informed. You've done your research, you've looked at patterns, you look at the fundamentals. That first trade is always going to be your best trade. So if you're wrong the first time, why would you be right the second time? So why would you double up? We never double up. If we're wrong, we cut our losses and move on. As we said, the benefit of option trading is that it's significantly lower capital than simple investing in the stocks, meaning it gives you a wider variety. And if you get out early, you can limit those losses really quickly, so only lose a minimal amount and move on to another strategy. The next mistake we recommend to avoid is trading illiquid options. So this goes back into kind of the rules that we sent. And this is so important because it can help you out in so many different ways. So liquidity in the market means there's a lot of active buyers and sellers at all times, with heavy competition to fill transactions. This activity drives the bid-ask price of the stocks and options closer together. The market for stocks is generally more liquid than their related options markets. That's because stock traders are just trading one stock, whereas people trading options on a given stock have a plethora of contracts to choose from, which differ with different strike prices and different expiration dates. At the money and near the money options with near-term expirations are usually the most liquid. So the spread between the bid-ask price should be narrower than other options traded on the same stock. As your strike price gets further away from at the money or the expiration dates gets further into the future, options will usually be less and less liquid. Consequently, the spread between the bid and ask prices will usually be wider. Liquidity in the option market becomes even more serious when you're dealing with illiquid stocks. After all, if the stock is inactive, the option as a derivative of it will probably be even more inactive, and that bid-ask spread will be even wider. So let's look at a quick example. Imagine you're about to trade in a liquid option that has a bid price of $2 and an ask price of $2.25. That's a 25% difference, and it might not seem like a lot of money to you. In fact, you might even bend over to pick up a quarter if you see it on the street. But for a $2 option position, 25% is a full 12.5% of the price. Imagine sacrificing 12.5% of any other investment right off the bat. Imagine if you were to buy a house and you're like, okay, I spent all this money, but then the bank comes around and goes, no, we're going to devalue it by 12.5%. Or someone just said, you go, I want to exchange this $100, and we're like, we're only going to give you back $88.5 from that $100. You wouldn't accept it. So don't accept it in option trading. And that's what happens when you trade illiquid stocks. That bid-ask spread is wider, and you'll have to compensate, by giving up your money. You'll either pay too much or you won't be paid much at all from it. It makes sense to trade options with high liquidity in the market. A stock that trades fewer than 1 million shares a day is usually considered illiquid. However, we do recommend trading at a minimum of $500,000. $500,000 is the bottom. $1 million is recommended, but $500,000 is the bottom for us. So options trade on the stock will most likely be liquid too. When you're trading, you might want to start by looking at options with open interest at least 5 times the number of contracts you want to trade. So if you're trading 10 contracts, your minimal accepted liquidity should be 10 times 50 or an open interest of 500 contracts. Obviously, the greater the volume an option contract, the closer the bid-ask spread is likely to be. Remember to do the maths and make sure the width of the spread isn't eating up too much of the initial investment, going back into what we spoke about here. Because the numbers may seem insignificant at first, in the long run, they can really eat up. Instead of trading illiquid options, you might as well trade the stock instead. There are plenty of illiquid stocks out there with opportunities to trade options on them. So liquidity, liquidity, liquidity. Do not trade illiquid options. It's very easy it's good. If you have an illiquid stock, first off, if you have an illiquid stock, just avoid the options because it will be very, very hard. We recommend at least $500,000, preferably over 1 million stock transactions per day. Open interest, we recommend of at least 100 open interest, preferably over 500. There is nothing bad about having more liquidity. Nothing bad. There's so many things about having illiquidity, not being able to trade it. So the last mistake we recommend to avoid is waiting too long to buy back short options. So always be ready and be willing to buy back short options positions early. Don't wait around. Far too often, traders will wait too long to buy back the options they have sold. And there are a million reasons why. Investors don't want to pay the commissions. Investors are betting the contract will expire worthless. Investors are hoping to eke just a little bit of profit out of the trade. Don't be greedy. Recognize when you're wrong and keep emotion out of the trade. Buying is good. Not buying, you got to remember, do not wait too long because if it goes into the money, you'll have to buy 100 shares of the underlying stock for the call and give it to somebody, or buying 100 shares for yourself for a short put. So you got to be careful. If you wait too long, it could backfire on you a lot, very badly. So there were some rules that we recommend to follow and mistakes to avoid. If you have any other rules or mistakes that you hear about, we'd love to hear about them. Our next video that we're going to cover is going to be move on to chapter 11. So we've done chapter 1 through to chapter 10. Now we're going to go through to chapter 11. And chapter 11 is all about our exam, a very, very fun exam. So this is going to be a 120 question exam. It's going to be multiple choice, and it's going to cover everything, well, not everything, but mostly everything that we've covered throughout this course. There'll be no question in the exam that we haven't already discussed. So it'll be a lot about identifying what is the strategy, what do you do in this situation, if you buy it here, how much it's going to cost you. So we recommend putting a calculator aside, putting a notepad aside, and getting straight into it. Make sure you block off a couple of hours because it is quite long. Anyway, let's move on to chapter 11, our exam.